Right, we have to talk about shorting the market, and I think it's going to be quite an interesting topic because in the past 3 to 4 months, or actually a little bit longer, I actually have been shorting the market as well. And there are several DMs asking me how am I actually shorting the market. Am I actually shorting the SPY, which is the index that is mirroring the S&P? Am I shorting Apple, which is the highest market cap company in the world right now? Like, how am I actually shorting the market when I say that I'm taking a short position? So today we want to do a portfolio dive sort of video, simply because I think that the market is pretty mild at the moment. And honestly speaking, because I'm not sure why, but my video seems to be like shadow banned whenever I'm talking about China or politics. So I'm just going to be straying away from that and talk about my portfolio today. So let's talk about shorting the market, and we are going to be talking about the SQQQ. For people who do not know what the SQQQ is, it's basically an inverse leverage ETF. So to put it simply, it is an ETF that goes the opposite direction of whatever the Nasdaq does at a leverage position. So to give you an example of how this actually works, when the Nasdaq goes up by 1%, this ETF would go down by 3%. Similarly, the other way around, when the Nasdaq goes down by 1%, this ETF will go up by 3%. And of course, it's not going to be an exact 3%. Along the line, this ETF actually take about 0.9% of fees. So just you gotta take note of that a little bit. So that's where it actually gets a little bit expensive. You do not want to be holding onto this position for the long run. Like, you don't want to be long this for like 2-3 years in a row, because the fees are going to be destroying you effectively. And that's kind of the position that I've been holding on to, but that's not the only instrument that I am working with right now to short the market, because there's actually multiple ways for me to do so. So right now, full transparency, SQQQ at the moment is sitting at about 17, close to $18, and my average for the SQQQ at the moment is at $19. Okay, so I've actually been buying into SQQQ since I think when it was $24 or $25-ish. And you know, I found out about SQQQ about 4 to 5 months before Russia invaded Ukraine, which is about close to a year and a half ago. And I decided to buy into SQQQ about 2 weeks or 3 weeks before the invasion itself. And I made a good chunk of money when the invasion actually took place. I actually talked about it as well back in during the invasion period of time. I made a lot of videos during those times, and I talked about how I'm actually shorting the market, how I think that it's going to be bad for the economy, how World War III is basically on the verge of happening, and things like of that nature. And afterwards, I basically sold my position on it. Of course, it wasn't that big of a position because I was actually just trying it out. I was basically still learning about what this inverse leverage ETF is all about. Afterwards, I actually read up a little bit more about it, and I thought this is basically where I'm going to be shorting the market, and that's my position, or that's my instrument for me to short the market. So now let's talk about why I did not want to just short the SPY, or why did I not want to just short the Apple stock or the Nvidias and such. So first things first, I do not want to short stocks in general, meaning company stocks, so such as Apple, your Meta platform, your, I don't know, like Nvidia, AMDs and such. The reason being is because shorting one company on its own is not going to be very, very valuable. Simply because there's such a huge volatility. Something for us to actually take note of for the volatility is that if the company just suddenly have one good earnings, your short just get destroyed anyway. Okay, and of course you can say that they can get a bad earning, but the thing is that we were really in dire straits at that point of time when we were talking about shorting the market, and basically everything has been going downwards. Everything has been going upwards simply because we have been all the way down. What's the opposite for peak? Like the pit. Like we're at the pit of everything. So I believe that at that time, for you to actually be shorting Apple or shorting Nvidia wouldn't really make a lot of sense. This was back when Nvidia was, I think, about like $130 or so. Right now, Nvidia is sitting comfortably at $480. Okay, so you can clearly tell that if I were to short Nvidia at that time, right now I probably would have been bankrupt. Okay, like I'm losing like what 200% or something ridiculous, or 400%. Like nah, like I'm not doing that. So the one of the reason why, which is why that I do not want to short companies directly, is because of that. The volatility in just earnings report or just any bad or good decision a company were to make. And let's not forget the AI boom. Whenever a company just talk about the word AI, they're just gonna go up by 20%. And I don't think that was the really good time for me to short the market whenever a company just say AI and then I just basically lose 20% of my money. Okay, I didn't think that made a lot of sense. Okay, now why I did not just short the SPY or short the Qs and such. Pretty simple, simply because I do not want to be shorting stocks on cash alone. So, for example, if you are shorting on cash alone, it's that's just a level higher than naked shorting. I'm shorting with money, okay? I'm cash shorting it, but at the same time, my downside potential is limitless, or basically my upside potential is limitless at this for this situation. So if the SPY were to just spike up like 20% in like 4 weeks or 5 weeks, I'm gonna be losing a lot of money. And similarly for the Nasdaq as well, because we have seen Nasdaq actually spike up 25% in 4 months. So I don't want to be putting in cash that way, because if I were to be putting in cash, I'll be eating the whole entire chunk of the increment as well. And when I'm doing it that way, I'm basically opening myself to a possible margin call, and I'm not really a big fan of that. Okay, so that's one of the reasons why I did not want to do a cash short. Another thing of why I wanted to do an inverse leverage ETF. Okay, honestly, the thing is that I most likely could have just went with an inverse ETF rather than inverse leverage ETF. I just wanted to have a little bit more of a risk appetite. Especially back then when the market was still going down pretty heavily, I made a lot of money, so I thought that it was a pretty good move. Do take into consideration that I actually started buying into this SQQQ when it was about like $25, I guess, $24, $25. And I managed to DCA into it all the way down to $19, and I'll tell you how I actually did it. I did it via options. And I think this is something that I actually advocate for, which is having shares and then selling stock covered shares, stock covered calls. So I have stock covered calls, basically covered calls that I'm selling almost every 2 to 4 weeks, depending on the premium that I'm going to be getting. Whenever I get the premium, I'm going to be using it to buy more SQQQ. That's basically how I did the spread for the whole entire portfolio for shorting the market. So effectively, I managed to get all the way from 25 all the way down to about, I think, $20 or so. And then at $20 or so, I also have taken about dividends, I believe, 2 or 3 times. Which then also helped me to bring it down to about $19 or so for the average cost of my SQQQ. So that's basically what I have been doing to short the market. Of course, again, not financial advice. Honestly, at this period of time, I would actually tell people to not really take on my position. Because right now, honestly, I am also trying to get out of my position. I do not want to be so stern on shorting the market, especially if you were to look at macro trends right now. There's not really much headwinds for us. People are saying that recession is not going to be happening anymore. Inflation is basically gone. Rates are basically going to be pausing in the next FOMC meeting. Chances are, we're not sure. Employment is doing pretty well. Unemployment is starting to stagnate a little bit. So basically, all the different headwinds that we actually had back in 2022 is starting to basically disappear in 2023. So I still do adopt the mindset that inflation is most likely going to be a little bit more persisting, because right now core inflation do show a little bit of persistence that it's not going to be going down. And what that would actually translate to is that we are not going to be getting 2% inflation, if in actual fact we're most likely going to be getting closer to 3% inflation year over year. And what that actually translates into would effectively be that the economy will be doing not as well because people are spending a little bit more money on the economy, and then effectively what will happen is that they will have to start laying off workers, and then economy start to tank a little bit, and the first few companies that usually get affected are the tech companies, which evidently usually are present in the Nasdaq as well. So that was my whole entire train of thought. And I feel that if that were to be the case, I think this is a strong argument or theory for me to actually play out on. And that's why I actually went with the whole entire short. But of course, like I said, if you're not really short on the market, or you're not actually very committed to the fact that the market is going to be shorted to that extent, try your best not to just short the market that way. It's pretty dangerous. Do understand that, again, this is completely not financial advice. I need to really emphasize this, especially because, like I said, it's dangerous. Chances are things are not really looking good for this part of the portfolio, but I'm still sharing it with you guys because I just thought that it's pretty interesting, and people do not understand how shorting the market works, or at least how I am shorting the market, and I thought that it's quite an interesting perspective to share with you guys, instead of just shorting companies like people like all those corporate who were shorting GameStop and shorting AMC. They were just shorting the stock directly. That was affecting the price. But for me, I'm just basically getting into inverse leverage ETF, and that's how I actually get the money back. But yeah, anyway, that's all I have for this portfolio dive. I do probably still have about 3 more companies that I have not talked about. So I'll actually see if YouTube decides to shadow ban this video again. If YouTube decides to shadow ban this video again, then I don't know. I will have to think about how to create different content to not get shadow banned. I don't know. But anyway, that's all I have for this video. Thank you so much for watching, and I'll see you guys in the next one.